Welcome to today's edition of For Our Financials Financial Forum, where we will share some information regarding the markets and present our Wealth Wisdom Workshop. And in today's Wealth Wisdom Workshop, we are talking sequence of returns risk and why the order of returns matter more than the average returns. So without further ado, Jeffrey will get us started with this week's Markets in Motion.
So welcome to this week's Markets in Motion as usual. Markets delivered their strongest weekly performance in nearly 4 months as investors responded favorably to a combination of solid second quarter corporate earnings, and that kind of eased the geopolitical concerns, and then a labor market report that may influence the Federal Reserve path on interest rate all kind of helped us out this week. So for the week, the S&P 500 gained 3.57%, the Dow Jones Industrial Average gains 2.96%, and the NASDAQ Composite surged 5.19%, powered by renewed leadership from large cap technology stocks. International markets also participated in the rally, with that index rising 2.32%. The primary drivers of the week gains were encouraging corporate earnings and results and a shift in interest and investor expectations, surrounding kind of monetary policy. And then investors were encouraged by healthy profit trends and a corporate environment that continues to support innovation and productivity gains. So another significant development came from the labor market. The July employment report showed the economy unexpectedly lost 23,000 jobs, making the first monthly contraction since February. In addition, prior month's jobs growth figures were revised lower, adding evidence to that the labor market conditions are gradually cooling out.
Yeah, so investors viewed that report through the lens of the Federal Reserve policy. So markets interpreted the softer labor data as potentially reducing pressure on the Fed to keep short-term interest rates elevated for an extended period. So as a result, expectations for future rate cuts have increased, helping fuel gains across both the equity and fixed income markets. So for investors, last week's market action reinforces an important theme. Markets remain highly sensitive to changes in growth, inflation, and interest rate expectations. While economic growth continues, investors are paying close attention to signs that inflation pressures are moderating and that monetary policy could gradually become more accommodative.
Mm-hmm. So the markets rallied broadened. So while technology stocks led, performance gains extended across major asset classes and international markets, and which is a healthy sign for diversified portfolios. Interest rate expectations remain a key catalyst. So markets are increasingly focused on when and how aggressively the Federal Reserve may adjust policy over the coming months. And then volatility creates opportunity. So the short-term market swings can provide strategic planning opportunities for tax management, portfolio rebalancing, and then selective investments in long-term growth themes as well.
So, for successful households, the biggest takeaway from last week is that the investment landscape remains constructive despite this ongoing uncertainty. Corporate earnings have generally exceeded expectations, inflation has continued to moderate, and investors are increasingly anticipating a more favorable interest rate environment. As we move into the coming weeks, market attention will shift toward inflation data, including the CPI index and producer price indexes, along with some other data. So for now, the combination of improving earnings visibility, easing rate concerns, and broad market participation provides a supportive backdrop for long-term investors focused on growing and preserving wealth through this changing market cycle. So that's going to be your Markets in Motion update for this week. And now we'll shift over now to the Wealth Wisdom Workshop. And again, our topic this week is why market timing matters more than you think in retirement. So understanding sequence of returns risk.
Mm-hmm. All right, so let's get started with our Wealth Wisdom Workshop. Let's begin it with a question. If two retirees start with the same amount of money, take the same withdrawals, and earn the same average investment return over retirement, should they end up with the same outcome? Most people will say yes, but surprisingly, the answer is no. One retiree could successfully fund their lifestyle for decades, while the other could run out of money years earlier.
So how is that possible? I was a math major, so average return, you would think they'd end up at the same place. But because retirement success is not determined solely by how much return you earn, is often determined by when those returns occur. And that's what makes today's topic, sequence of returns risk, one of the most important yet least understood threats in retirement planning. So, just like the topics we've discussed before, this isn't ultimately about investments. It's about protecting what those investments are meant to provide, taking care of your family, enjoying a work optional lifestyle, pursuing travel and recreation, living the retirement you've spent decades building toward. The dangers of that sequence risk can quietly undermine all those goals without most people ever realizing it until significant damage has already occurred. So when people evaluate investments, they often focus on average returns, and that seems logical. After all, if a portfolio earns 7 or 8% over time, that sounds like a solid result. But retirement introduces a critical factor that changes everything: withdrawals. Once you begin taking income from your portfolio, the order of market returns becomes extremely important. Sequence of returns risk is the danger that poor market performance early in retirement, combined with ongoing withdrawals, can permanently impair a portfolio's ability to recover. So the key lesson is simple. It's not about average returns. It's about when returns occur. All right. So Jeffrey, get us started with some of these obstacles that we will see as a result of sequence of risk return.
Yeah. So the first obstacle is going to be withdrawals amplify losses. So during your working years, market downturns are often just temporary setbacks. So in fact, many investors continue buying shares during market declines through their retirement plan contributions. But retirement changes the equation a little bit. So now imagine a market declines 20%. At the same time, you're withdrawing money for living expenses. That is result is what we call the double impact. First, the portfolio declines because of market losses. Second, you're removing assets from the portfolio while it's down. And those withdrawn dollars are permanently gone and they won't participate in the eventual recovery. So what could have been a temporary setback during accumulation now becomes a potentially permanent loss of retirement capital, which is big. So that leads us into obstacle number two, which is early losses matter a whole lot more than the later losses. Um, One of the most surprising realities of sequence risk is that timing matters more than most people realize. A significant market decline in year one of retirement is far more dangerous than the same declining occurring in year 15. Excuse me. And why is that? It's because earlier in retirement, your portfolio is likely at its largest value. Your withdrawals are just beginning. You potentially have decades of retirement ahead. When losses occur during those critical early years, the portfolio starts shrinking from the very foundation it's supposed to build upon. Instead of compounding growth working for you, you're fighting from behind, and that creates a gap that may never fully close. Then that takes us into obstacle number three. Average returns can be misleading. This is where many retirees unknowingly get trapped. We're often taught that long-term averages tell the story, but sequence risk prove that that's not always true. Consider this example. One retiree experiences negative returns early and positive returns later, while another experiences positive returns first and then negative returns later. Both retirees may achieve the same exact average return over time, yet the outcomes will be dramatically different. The retiree who experiences losses early may deplete assets years sooner simply because withdrawals occurred during the wrong part of the market cycle. Um, in other words, we're going to obstacle four, which is traditional planning often misses the risk. Another challenge is that many retirement plans are built using assumptions that accidentally hide sequence risk. Traditional planning often relies on historical average, straight line projections, fixed withdrawal assumptions, and then expectation that markets will cooperate. Unfortunately, retirement doesn't happen in a spreadsheet. Real life happens, and that includes market corrections, bear markets, inflation, healthcare costs. Um, a plan that looks successful on paper can become vulnerable with real world volatility arrives.
And that's the gap that most retirees just simply don't see. So the biggest gap isn't
Mhm.
necessarily insufficient savings. The biggest gap is often the absence of a strategy designed to manage this timing risk. So most people spend years focusing on accumulation. How much money do I need? But retirement requires a different question and different equation. How do I protect income when markets don't behave as expected? Sequence risk forces us to think differently. It challenges us to move beyond balances and averages and focus on sustainability, because retirement isn't won by having the highest return. Retirement is won by having income available when you need it. So, our closing thought: as we close, reflect on the retirement you've envisioned. Now, ask yourself this: if the market experienced a significant decline during the first few years of your retirement, what would happen to your plan? Would your income remain secure? Would your lifestyle remain intact? Would your strategy allow you to adapt? Or would your retirement become dependent upon markets recovering quickly? Because the reality is this: most retirees focus on how much money they have. Very few focus on when returns occur. Yet one of the greatest determinants of retirement success is not the average return, it's the sequence of those returns. So the question I want you to consider is your current retirement strategy designed to protect your future if returns arrive in the wrong order? Because retirement isn't just about accumulating wealth. It's about making sure that wealth can continue supporting the life you want to live. So that will wrap up today's session on the Wealth Wisdom Workshop, and we look forward to seeing everyone next week. Stay cool. It's mighty hot in North Carolina this week, so you all stay cool, stay hydrated. Until next time, we'll see you. Signing off.